Hello, welcome back to Life Enrichment with Hank Ballinger. Last time on this channel we talked about getting out of debt. Again, that's one of those topics nobody likes to talk about, but a very important topic when talking about building wealth. It's hard to build wealth until you get out of bad debt. Now, I want to talk today about the difference between bad debt and good debt. There is a major difference. And what I'd like to do is explain the difference between bad debt and good debt with a little illustration here. So let's imagine that you just inherited $1 million. Now, most people would think, wow, that's enough money. I can do whatever I want the rest of my life. Generally not the case. Generally, as you remember, an earlier episode, we said 85% of all sports stars, baseball, basketball, and football players are broke 5 years after they get out of the sport. 93 to 95% of all lottery winners are broke about 2 years after they win their winnings. Excuse me. So what we want to see is the difference in how someone uses the $1 million they won. So we got an example over here. Someone wins $1 million. They inherit it. They go out. The first thing they do is they buy a candy bar. When they buy a candy bar, they are no longer a millionaire. They have gone from millionaire status to not being a millionaire because they bought a candy bar. But let's look, if that's the mindset, you take that winning and you start spending it, that's bad debt. So let's see what that mindset person generally does. Now remember, they've already bought a candy bar. But because their mindset is to take the $1 million and spend it, the second purchase is they buy a $500,000 house. The second purchase is the guy goes out and buys him a car. Well, now you got to think. If the guy goes out and buys a car, his wife is probably going to want a car too. So they go out and buy another $100,000 car. Then they decide, well, we like to go on vacations and we want to, we're water dogs. We like going to the beach and to the rivers and we like being on the water. So we're going to buy a nice boat. So they spend $100,000, and that may not be a really nice boat today's time, but they spend $100,000. Just go with me on this. They spend $100,000 on a boat. Then they spend about $50,000 on jet skis and all the other paraphernalia that goes along with being on the water real often. Then they say, well, we like camping too, so we want to go nice places, and so we want to buy a nice camper, and they spend about $100,000. Now you could go from $100,000 way on up on campers, but again, go with me on here. They spend about $100,000 on a camper. Then they say, well, we like to take really nice vacations. So they start going all over the world, taking really nice vacations, plural, more than one per year, spending a lot of money and a lot of time away and spending a lot of money on these vacations. So they spend about $100,000 on vacations. Then, when they are living that lifestyle, they realize their lifestyle costs them about $100,000 to live each year. But there's a problem. If we start doing the math, 5, 6, 7, 8, 9, there's $1 million. There's $1,050,000 spent before the $100,000 living expenses. So the 10th thing they do is they start selling their stuff back because they're broke, but they sell it back at a greatly reduced price. And then in about 2 years from the time they inherited their $1 million, they're broke because they started spending that inheritance on bad debt, on things that wouldn't make any money. It costs them money. Now let's look at example number 2. You inherit $1 million, but you decide, I'm not going to just spend it like example number 1. I'm going to invest that money. So you go out and you find a $1 million rental, maybe a multifamily. Guy's asking $1 million for it. You say, well, that's pretty good. I only have to put up 20% because the bank will do an 80-20 split. The bank put up 80%. I got to put up 20%. So I only have to put down $200,000 and I can get a rental property. So the bank, it's a $1 million property. You put down $200,000. The bank puts up $800,000. That's a pretty good deal. Now, interest rates have gone up. Let's say you have a 6% interest rate and you amortize that loan on 25 years. Means it's going to take you 25 years to pay that loan off. Your debt service to the bank, most people would call it a mortgage. It's technically a debt service. Your debt service to the bank per month is $5,155. Your tax is $850, your insurance is $635, your garbage is $100, and your maintenance per month is about $2,000. Now, your total expenses, debt service, taxes, insurance, garbage, maintenance, is going to be about $8,740 a month. Now, let's say, hypothetically, that you got a 20-unit apartment building with that $1 million. Now, each unit is bringing in $500. You're bringing in $10,000 a month. But remember, your expenses was $8,740 a month, meaning you have a cash flow. Each month, you're going to make above all your expenses, you're going to make $1,260 a month cash flow in and above all of your expenses. But wait, there's a lot more. Here, remember, you only spent $200,000. You inherited $1 million. You can do this scenario 5 times. So when you look at what you would normally make, $1,260 as cash flow, that would be your monthly cash flow is $1,260. But remember, you can do that 5 times. You would have $6,300 a month from those $5 million properties. You would have $6,300 a month coming in. Now let me ask you a question. If this guy bought a candy bar and he fell out of millionaire status, and you've got $6,300 a month coming in, but you still maintain your $1 million in equity in the property, so you're still a millionaire, and you're making $6,300 a month, you can buy a lot of candy bars with $6,300 a month, and you're still a millionaire with good debt. You see the difference between bad debt and good debt. Good debt will make you wealthy. Bad debt will make you broke. So you've got $6,300 a month coming in. Remember, example 1, this guy bought a candy bar and he's no longer a millionaire. This example, this guy, he bought $5 million properties and he can buy all the candy bars he wants and he is still a millionaire. But it gets better. Now, let's say that you could live, remember you got $6,300 a month coming in, and let's say you wanted to be redneck rich. You want it to be to where you're living on half of that. So you're living on $3,150. Remember, redneck rich, you keep those expenses down. You have residual income, and you don't have to work a job every day. If you did this, you could be there. Now, you could live on $3,150 a month, and your cash flow would be double that, so you could invest $3,150 back into the company to buy more property, which would then up your cash flow each month, which means you could buy more property quicker. But again, it gets better. Remember, as you're making this debt service right here to the bank, you're making a $5,155, but that's 5 times that amount. And you're gaining equity on every one of those payments. Now, on the first month, the equity you would make at 6% and on 25 years, you would be making $1,155 worth of equity on that property every month. But that's just the one property. You've got that 5 times, meaning you are making $5,775 worth of equity every month because of good debt. This guy is not, because he bought a candy bar. Now, if you pay those properties off in the 25 years, you put them up on the loan for the bank, you pay them off in 25 years, you would have $5 million worth of property in 25 years. But it gets better than that. That property, if you bought it 25 years ago and it's taken you 25 years to pay it off, don't you think that property would go up in value in 25 years? Yes. At a conservative amount, it would go up at least 3% per year. Now, if that property went up 3% per year, in 25 years, that property is now worth $10,468,889. And you've done all this because you didn't buy a candy bar. Bad debt. You used it for good debt. You invested in real estate. So now you have a property worth over $10 million. But remember, you had $6,300 a month coming in cash flow every month from these 5 properties. If you take that $6,300 times 12, that's 12 months in a year, and then times 25 years, you will have made in that 25 years, you will have made $1,890,000. But it gets better. Remember, that's if you never had a rent raise in all of those 25 years. You will have a rent raise in those 25 years. So, you will have gained $5 million in equity, $1,890,000 cash flow. So in 25 years, you will have raised the value of your property to $10 million, made over $2 million in cash flow. Now, you are going to have rent raises, and those rent raises, because the value of rental property is tied to the income. As the income goes up, so does the value of the property. So as you raise rent, you're raising the value of that property. So you can do either one of these examples. There is bad debt and there is good debt. Now, it's your choice. If you inherit $1 million, you can invest and really exponentially grow that amount. Or you can buy a candy bar.